Hi, everybody. Thanks for joining in today. So today's AMA session is going to be a special one. Usually in our AMA sessions, we talk about things like what is happening with the market, uh, you know, what is happening with the performance of a specific small case, what have we done with rebalance and stuff like that. With today's AMA, we don't want to talk about the market. We don't want to talk about what is happening with a specific small case or anything of that sort. The idea is we want to help investors. Think of today's session as more educational in nature. We want to help you understand what is the best way to approach investing in a portfolio. Now, that portfolio might be a small case. That portfolio might be a mutual fund of your choice. It might be a PMS investment, whatever it is. What is the general approach that investors should take when getting into any one of these products is what we are trying to discuss today. So just to give a little bit of background as to why we are attempting to do that, uh, we keep getting calls from customers or in potential investors or even investors who's saying like they look at specific small cases based on returns. They say we are interested in investing in it. They don't really deep dive into the investment theme of the small case. They don't try to break down the performance of the small case to understand why it has been performing well, and they just look at returns and sort of want to invest in it. This is one of the reasons why we sort of wanted to, that is one of the first reasons why we thought we should have an educational session. The second reason is sort of like an experience that we had with a couple of investors recently. They had sort of invested in low volatility portfolios, and obviously in a low volatility portfolio, the returns will not be as good as what returns equities generally generate during bull market, right? And these people who had invested in these products were very, very disturbed by the performance of the portfolio, and they were complaining, saying that this is not done, the manager is not doing well, and a whole host of things. So there seems to be a lot of misunderstanding, misconceptions when it comes to investing in portfolios. Now, like I told you, when I'm talking about portfolio, I'm not just talking about small case. Whatever we are going to discuss in today's section, you can go ahead and apply these rules to any portfolio investment, sort of like, whether it is mutual fund, whether it is PMS, whether it is small case, anywhere, the rules are going to be applied, can be applied. So let's get started. So just to give you a little bit of context, the chart that you see over there is basically the total number of demat accounts that have been opened during each financial year in India, and you can obviously see that growing spike. And at the end of March 2024, there were close to 15 crore demat accounts, and this is like about a 32.25% raise on a year-on-year basis. Obviously, the bull market seems to have contributed to everybody's enthusiasm in terms of opening demat accounts, and everybody wants to invest in equities and stuff like that, which is good. But at the same time, a lot of this investing in equity is a do-it-yourself activity, right? You have to go out and pick a mutual fund for yourself. You have to figure out which small case you have to invest in, or if you're taking the PMS route, you have to figure out which PMS is good for you, and within that PMS, which particular portfolio will work for you, and all of these aspects. So, like, this being the background, there are certain things that people have to keep in mind when going in for investing via the portfolio route. So let's get started. Now, first mistake that most people do when investing in these portfolios are they sort, if I were to give, a list of small cases or mutual funds, what most people will do is they will sort, the small cases or the mutual funds or PMS plans or anything by returns, and they will pick the top 2 to 3, such portfolios, and they'll say these are the ones that we are interested in. Now, there are a couple of different problems in following this method. The first thing is the base period performance. Now, look at this table over here. There are two portfolios. Portfolio A was launched in March 2020, and then there was Portfolio B that was launched in December 2019. Uh, so not too much of difference, just 3 to 4 months difference in terms of launch date. And let's go with the assumption that the underlying theme of both these portfolios are the same. They are attempting to give you exposure to the best stocks in Nifty 50. Now you can look at the CAGR returns, between these two portfolios. In terms of portfolio A, the CAGR return since March 2020 is 18.7%, whereas in terms of for portfolio B, the CAGR returns, which was the portfolio was launched in December 2019, the CAGR returns is just 10.4%. Now, most people, what they will do is they will automatically go for portfolio A, right? But why? Everybody is getting enthused by that 18.7%, whereas if you deep dive a little, you can see that the launch date are just 3 months apart. The underlying theme remains the same. So how does 18.7% make a difference to anybody's life? These are historical returns between two specific dates, right? So this does not, there is no way to understand, or there is no way to determine that portfolio A is a superior portfolio by any means, right? But in spite of that, what most people will do is they get enthused by this base period returns. They don't take into consideration when was the base period, when was the launch period, and stuff like that, and they will automatically go for portfolio A. Now that leads us to a second problem, which is high returns. Now, high returns, one should understand, is not always low risk, right? Somehow, people seem to think about high returns as automatically low risk. That is not the way it works. They think missing out on returns results in more risk. That is not the way it works. In case of any portfolio or stock, the understanding should be the more risk that you're taking with investing in a particular portfolio, your investors' expected return should be on the higher side. Now, please understand this. Expected returns does not always translate into actual returns. So let me give you an example. There are two portfolios. Let's take the example of portfolio A and B that we just discussed. Portfolio A is going to invest in, let's assume, a thematic portfolio. Let's assume something like the chemical industry, the best stocks of chemical industry. Whereas portfolio B is going to pick up the best stocks out of Nifty 100, universe. Now, over a period of time, portfolio A might end up giving good returns. Portfolio B might be able to give stable returns, but not as good as portfolio A. So when people are going to assess these portfolios, they go in with the idea that because portfolio A has given better returns, that must be the better portfolio. Well, that is not the case, right? We don't really understand, because first thing that has happening with portfolio A is it is very, very sector specific. We are looking at best companies in chemical space. So that's sort of like concentrated portfolio. There's not a lot of diversification there. Whereas with portfolio B, because you're looking at best stocks out of Nifty 100 or Nifty 50, whatever it is, automatically there is more amount of diversification. So just because higher returns are getting generated, it does not automatically result in lower risk. So one has to understand past returns aren't a guarantee. So consider both risk and returns when you're choosing investments, right? Moving on. Why do investors sort of get into these kinds of problems where they are talking about where they're getting influenced by base period returns, why they don't understand high returns is not equal to low risk and stuff like that? There are a couple of behavioral factors that affects all of us when we are trying to make investments, right? And this is a subject that has been studied across the world. People have won Nobel Prizes by doing these studies and stuff like that. There are a whole host of books available in the market for you to read. You can just look it up. You can look up books about behavioral investing. And probably one of the most easiest ways to avoid making mistakes when investing is to make sure that we understand our own behavior when it comes to returns. We understand our own behavior when it comes to discipline of investment, risk-taking ability, and all of these things. We'll deep dive more, but a couple of different biases that I would want to highlight is first one. I'll go with the most important one, this FOMO frenzy. So let me borrow Gen Z language a little. FOMO, for the uninitiated, stands for fear of missing out. So just because something has worked in the past, just because one of your friends invested in a portfolio 3 years ago and has made good amount of returns, does not mean that it will work on you, work for you, right? So you should not go in and invest in a portfolio just because it has done well historically, or one of your friends invested in that particular portfolio or in that particular stock and ended up making good returns, you should not give into this fear of missing out idea and invest in it, right? That is the first one. Second thing, anchoring bias, right? Uh, this basically where you anchor your investment choices based on past returns, right? This is like the most common bias amongst all kinds of investors. Present them a list of portfolios, they will sort it by returns and pick up the top three in terms of returns. You should never anchor your investment basis investments based on historical returns. So that anchoring bias should be eliminated once you invest when it comes to investing. The third one and equally important one is recency bias. Now, we are all sort of we would have all made this mistake. If the portfolio manager or somebody suggests a couple of different small cases or mutual funds to us, what we would have done is we would have checked to see what is the performance of that portfolio over the last 1 year, right? And if it might be historically the portfolio might have performed extremely well. The theme of that particular portfolio might be very bullish, might be very relevant, might be expected to do well by everybody. But over the last 1 year, for reasons, for various reasons, the performance might not be good. Most people, what they will do is they will reject investing in such portfolios based on the recent performance. So there is a lot of emphasis on recent returns and the bigger picture associated with what is the theme of the portfolio, what is the historical performance, are there any long-term trends that are going to that are going to support the investment thesis of that portfolio. All of these things are going to get rejected, and there is too much emphasis that is going to be placed on recent returns. So this recency bias also has to be eliminated. Now, we have discussed in some detail what are the mistakes that we end up making. Now, let's also look at Windmill Capital's 4-step framework to pick up the correct kind of portfolio. Now, when I'm talking about portfolio, I'm talking not just about small cases. This framework can be applied or should be applied to whether it is a small case, whether it is a mutual fund, whether it is a PMS portfolio, any one of these things, you can go ahead and apply what is it that we're going to discuss. First thing is we have to understand our risk profile. Now, a risk profile, let me deep dive a little bit into it because this is extremely important. There are a couple of different things that we have to consider when investing, and specifically when it comes to our risk profiling. First, investment objective. When it comes to investment objective, we have to understand why are we making this particular investment. If are we trying to save up for our marriage? Are we trying to save up for our retirement? Are we trying to save up for our child's education? Or is it a very short-term goal? Do I just want to save up for next year's international vacation or that fancy bike or car that you want to buy? These are the factors that you have to consider before starting your investment journey, right? Or before you try to pick up any kind of portfolio, this is something that you have to consider. Now, within investment objectives, there are a couple of different things that you can consider. How old or young are you? The younger you are, you will have time to do more experimenting with your money. You will have the capability to sort of take on more risk on your side. The second thing is how long can you keep money in that particular investment, right? Is your time horizon for that particular investment just 2 to 3 years or less than 1 year because you are looking to go out on that international vacation next year? Or is it a long-term thing? Is it more than 7 years because your retirement is still probably 10 or 15 or 20 years away? So these factors have to be considered. Next thing, equally important thing that you have to consider is risk tolerance. How much risk will you be able to bear? So one way to understand this is, one question that you can ask yourself is, what happens? What am I going to do if my portfolio value drops by more than 20% tomorrow? What is my, response to that going to be? And this is based on a real world scenario, right? Anybody who's been investing for more than 4 to 5 years now, you would have all seen what would have happened to your portfolio during COVID, right? Between Jan 2020 and March 2020, we saw one of the worst meltdowns in recent times in Indian markets, right? I think Nifty dropped by more than 30% within a 3-month time period. So if real money was invested, um, and your money was invested in equities, your portfolio, a 50 lakh portfolio, would have easily gone down to 30 to 33 lakh within a period of 3 months. And that's probably a very good litmus test to understand what is your what is your response going to be. A lot of people would have lost their minds. They would have, liquidated their entire portfolio and tried to move everything to, fixed deposits or debt funds or something of the sort. But then there are people who understand the working of the market, who would have said, okay, I have some extra cash, my portfolio has fallen by 33%, but I know the quality of my portfolio, I'm going to go and invest more in that particular portfolio. So there are both kinds of people, and this risk tolerance, we have to understand for ourselves, where is it that we fall on both of these sides. There is no right way or wrong way looking at it, right? It is just that we have to have a good understanding of whether our risk tolerance is on the higher side or on the lower side. Another factor to consider in terms of your risk profile is your financial situation, right? What is your cash requirement? How stable is your income? Are you a government employee and you are assured that you're going to get a salary at the end of every single month, or are you a businessman where your business might go through cash flow problems? Do you work in a large private sector company and your income profile is fairly stable? Do you work in a startup where you might be getting a good package, but it is still a startup and the business model has not been set, and the income profile is unstable? So all of these factors. Another factor to consider is how many dependents do you have, right? Is it just you that you're young and single, or maybe even middle-aged and single, and there are no other dependents on you? You don't really have to take care of parents. You child yet, and make sure that your child's education and any other aspects of life are going to be taken care of. And then the final factor is obviously knowledge and experience. How well do you understand markets, right? Usually what happens is, if people have good understanding of the market, they have good knowledge of the market, then the risk tolerance tends to be on the higher side. um, this is how risk profiling, these are some of the factors one should consider when doing risk profiling. And there are a whole host of tests that you can go online and take. If you just say risk assessment tools, Mire has a pretty decent risk assessment tool on its website. Money Control has a decent, risk control tool on its website. These are all free to use. They'll ask you a whole host of questions. They are all usually multiple choice questions. You can just sort of take the test to understand, and at the end of the test there is going to be a score that is going to be shared with you, and usually it falls into 3 or 4 buckets. Conservative, moderate, and aggressive. If you're a conservative investor, then probably you're better off having a lot of your investment in debt products or fixed income products. If you're a moderate sort of investor, it is probably better to go in for 50-50 sort of thing, where you have some of your investments in slightly lesser risk equities plus fixed income instruments. And if you're an aggressive investor, probably you're better off, or you're comfortable going in with a whole lot of equity investments, maybe even exposure to a lot of mid and small cap stocks or thematic portfolios, and then little less exposure to fixed income instruments. So this risk profiling should be the starting point of your investment journey. If you have not done this, if you have not thought about it, please go online. There are n number of free risk assessment tools. It's available on Money Control. It's available on Mire. It's available on Nippon India website. You can take any one of these things to understand where you're, how you are in terms of your emotional response to investing, in terms of, your entire approach to portfolio investing, what it should be. And then you can start your investment journey or recalibrate your investment journey, right? So that's the most important thing. Second thing to consider when it comes to portfolio investing is investment theme. Now, please, before investing, check to see what is the portfolio's theme and try to ensure that it aligns with your investment goals. Let me give you an example. So if somebody is talking about, investing in, let's assume once again, I'm going to go back to chemical space, chemical space, and if the portfolio manager is saying over the next 4, 5, or 7 years, the portfolio is expected to do well, but your investment horizon is just 3 to 5 years time, then obviously you should not be investing in the chemical space, because the portfolio manager himself is saying you have to stay invested in this particular portfolio for 7-year period, and your timeline does not match at all. The second thing, these thematic portfolios, a lot of time you will get exposure to mid and small cap companies, because these are the up and coming companies which are expected to do well and grow into large cap ones over a period of time. So if your risk profile is on the conservative side, then you should certainly not go in for such portfolios. Let me share a small anecdote story of an experience that we had very recently, in terms of how this investor did not understand the investment theme of the small case, and was very angry with us about it, because his portfolio was not performing as per his expectation. So you might have all, if you have invested in small cases before, you might have seen this safe haven small case, right? Safe haven small case basically, attempts to invest in low beta stocks, and low beta stocks generally tend to move slower when compared to, the market movement. So in most bullish phases, if the market has moved by 10%, low beta stocks generally come from defensive sectors like FMCG and pharma and the likes, and they will not move 10%, right? So one advantage of this particular portfolio is, even when the markets are falling down, these particular stocks don't fall as much. So their volatility tends to be on the lower side. So this gentleman who had retired and who was enjoying his retirement life, he had picked up the safe haven small case. He had invested in it, and over a period of time, he had stayed invested in it for probably more than 3-4 years. And over a period of time, he had made good returns and made very good risk-adjusted returns, which is the most important thing when it comes to this particular portfolio. But what he noticed was, during the recent bull run that we have been witnessing since March 2023, his portfolio had not done as well as Nifty benchmarks, right? And he was very, very cross about it. He called us and he was like, I'm extremely disappointed. This portfolio is not moving at all. The analyst should be fired. And he was a little cross with us about it and stuff like that. And we had to sit him down and give a breakup of a whole host of numbers and tell him, sir, this is the investment theme of this particular small case. This is how the portfolio is expected to perform, and it is performing as per our expectation or as per our understanding of low beta stocks. You shouldn't, sort of go ahead and invest in a low beta stock and then expect it to beat benchmark returns over any period of time. That doesn't happen. And we were able to show him the returns as well as the risk-adjusted returns. I'll come to what is risk-adjusted returns in the next slide. Risk-adjusted returns. And after that, he was placated and he was like, okay, I understand now. My bad in terms of not understanding the investment theme and going in for it. So this is an extremely, important thing. And once again, let me reiterate, whether you're investing in a small case, whether you're investing in a mutual fund, anything at all, please be mindful of the investment theme of the particular portfolio. And only if it aligns with your investment goals, your risk profile and stuff like that, then you should go ahead and invest. If not, stay away from it, regardless of the returns that it has generated historically. Now, moving on to the next part. The third angle is the volatility angle. Now, I told you the one thing. So first, let me deep dive a little into what is volatility. Volatility measures how much the price of a portfolio fluctuates. Imagine a horizontal line, right? And the horizontal line, probably if you were to draw a graph, stays at 100. And on a daily basis, the price of the stock moves up and down, right? One day it will probably trade at 101. The second day it might trade at 97, and then at 103, and then drop down and stuff like that. So if you were to draw a horizontal line at 100, and if you were to keep tracking the stock returns over a period of time, over let's say a month's time, it will keep moving between, up and down between on that 100 line. So if the dispersion of these dots, if you were to draw dots for everyday movement, if the dispersion was very, very large, then the volatility is very, very high, which means the risk is very, very high. If the dispersion is lower, that means the volatility is on the lower side, risk is on the lower side. I hope you understood, right? So basically, this volatility is how we understand risk of a particular portfolio. Now, that is one aspect to investing, understanding volatility. The second aspect to investing is risk-adjusted returns. Now, if I were to take my returns generated over a period of time, let's assume my returns was 24.5, right? You can see that for portfolio C. And my volatility during the same period was, let's assume, 10. So my risk-adjusted returns is 24.5 divided by 10, which is 2.45, right? This 2.45 is the amount of returns that I have generated for every single unit of risk that I have taken. So obviously, logically, the higher return that I generate for every single risk-adjusted, for every single unit of risk that I take, the better it is for the investor. So you can see two portfolios over there, portfolio C and portfolio D. And the 3-year CAGR for portfolio C is 24.5, portfolio D is 39.2. Then there is the risk adjusted aspect to it. Now, what most people do is they do not look at this risk adjusted returns aspect of the investment at all. This particular risk adjusted aspect, most people will ignore it. They do not tend to look at it. They will only look at this 3-year CAGR part of it. They will see 39.2, they will see 24.5, and they'll say, we want to go in for 39.2, right? Because it has generated more returns. But look at it from a risk adjusted perspective. Portfolio C has generated 2% or 2 units of return for every single unit of risk that it has taken. Whereas portfolio D, even though it has generated higher returns, has generated just 1.7% of return for every single unit of risk that it has taken up, right? So which one is better from a risk-adjusted performance or risk-adjusted returns perspective? Obviously, portfolio C, right? This aspect most people tend to miss, and this is what happens when presented with a list of portfolios. If you sort of sort it by returns and then pick up the top 3, this is a mistake that you will all end up making, right? The risk-adjusted returns aspect goes for a toss. You will simply go ahead and invest in a portfolio that has generated more returns, but it also means there is an underlying risk to it. You are just not seeing it. The risk exists, you are just not seeing it. Okay, so this is extremely important. Once again, whether it is small case, whether it is mutual fund, whether it is a PMS product, anything at all, any sort of portfolio investment that you're making, please consider risk adjusted returns alongside your returns, the absolute returns or the CAGR returns of the particular portfolio. And once again, lots of people either mail in or call and say that, I am looking to invest in a particular small case, and that particular small case usually tends to be value and momentum, one of our best selling small cases. Nothing wrong with the small case if you are looking at it from a returns perspective, but because it has done absolutely well, fantastic performance, like, whatever, probably upwards of 30%. I don't remember the recent performance, more than 30% returns. But all of these people, what they would have done is they would have gone onto the portfolio, or they would have gone onto the app, they would have sorted it by returns, they would have just looked at the returns perspective. If you to ensure that there is all sorts of transparency, there is a fact sheet available for each and every small case. Within the fact sheet, there is a Sharpe ratio that's available to you. Sharpe ratio indicates the risk-adjusted returns of that particular small case. So before you simply sort it by a small case returns and say that, you want to go in for investing in XYZ small case based on returns, take a look at the Sharpe ratio also to understand how much returns it has generated for every unit of risk that it has taken. And I don't remember the numbers, but my understanding is value and momentum would not have generated very high risk adjusted returns, because there is a lot of that selection of mid and small cap companies into that particular small case, right? Mid and small cap companies tend to be more volatile. More volatility means more risk. So risk adjusted returns tends to be on the lower side. You have to be mentally prepared for that. So that is so much about volatility. Final aspect of investing is obviously the cost associated with investing. Now, there are multiple things that come into picture when we are talking about cost, and there are costs associated with whether it is a mutual fund, whether it is a PMS, whether it is a small case. There are costs associated with everywhere. As far as small cases are concerned, we are very, very upfront about what are the costs, that get added on to your investing in small case. If you are not clear, please mail us. We'll send you a detailed, blog that discusses every single cost aspect to it. There is also a cost calculator that is associated with each small case. You can see that on the app. Please use that, right? If you're not too sure how to use that, write into us. We will share notes with you about it. So just to give you an example of how cost will work and how that will eat into your returns, let's look at this portfolio. So investment amount is 1.15 lakh, same portfolio, right? Let's assume it is portfolio C. Investment amount is 1.15 lakh, and the subscription fees over a period of time is 24,000 rupees, right? Percentage of investment amount is 20.87, which is this 24,000 is basically 20.87 of your investment amount is just subscription fees. And then there is transaction charges associated with it, which is 3,941. So that is another 3% of your investment amount. So you can see this 20.87 plus this 3.43%. The cost associated with investing itself is about 24%. So how much returns should the portfolio generate for it to make any sense for you, right? If you are going in for, let's assume, value and momentum small case or any such high risk small case, and your expectation is that yes, it will generate 30% returns for me, and your stars are aligned, you end up making 30% returns. Yes, that is also done. But after adjusting for all costs, you are just left with 7% returns, right? 30% minus 20.87 minus 3.43, right? So please consider the cost associated with investment. Now, here in the next portfolio, same portfolio C, but instead of 1.15 lakh, you've invested 5 lakh. The subscription fees remains the same, but as a percentage of your investment amount, it has dropped down to 4.8%, right? 24,000 divided by 5 lakh will be 4.8%. The transaction charges tends to be higher because you've invested a higher amount, but as a percentage of your investment amount, now that has dropped down to 2.15%. Now, even if the portfolio ends up generating 30% returns, how much returns have you made? 30% minus 4.8 minus 2.15%, right? So still makes sense for you from a risk adjusted returns perspective. So once again, whether it is a mutual fund, there is an expense ratio associated with every single mutual fund. You can look it up on the website. You can also look up such numbers on websites like Value Research and stuff like that. So if the portfolio says it has generated 25% returns, 25% minus the expense ratio is what the investor would have earned. You should remember that math in your head when you are shortlisting a mutual fund. Very similarly, there are costs associated with the PMS portfolios. A lot of times, investment managers will say 2% expense ratio plus 20% of any profit that you make beyond a certain hurdle rate. So this is usually the standard in terms associated with portfolio investing. So if you're doing any PMS investment, sit down with a portfolio manager to understand how exactly it will look like. If it comes to small case, if you're investing in a fee-based small case, there is a subscription fees that you pay up, and then there are transaction charges which are not associated with Windmill Capital at all. Just investing in equity, there are transaction charges. There are statutory charges like SCT and all of these things. Then there are your demat charges. Then depending on your broker, there are other charges associated. All of these transaction charges are there. So keep all of these factors in mind before going ahead and deciding the amount of money that you are investing. If it is a small amount of money, probably going in for a paid small case will not make as much sense because your returns post costs will not make it worth your while to take so much risk. So this is the 4-step framework that I was talking about. Next, while we are winding down, let's talk about 2 factors. One, what happens if the portfolio is new? So this is like trying to decide, okay, there is a new IPL team on the block, given that it's IPL season, and RCB is playing today, which is my home team. let's assume there is a new IPL team on the block. You have to decide. You have to you're sitting around with your friends. You're trying to understand whether they're going to do well or not. What are the things that you're going to look at? You're going to look at who the coach is, right? If it's a well-known name, then obviously you're going to be excited about the prospects of the team. You're going to look at who the players are within the team. Like, are they players who've been performing very, very well for India over a period of time? Probably you're very excited. Are they players like West Indian players who have a lot of experience with T20 across leagues across the world? Then probably you're very excited. So there are all of these. You're looking at essentially what you're doing is you're looking at the pedigree of the coaching staff. You're looking at the pedigree of the of the players and all of these aspects, right? Very similarly, if the portfolio is new, you have to look at the pedigree of the management team. You have to understand where the portfolio manager is coming in from, what is his educational background, what is his previous work experience. Has he has he done portfolio management or investment management earlier? What are the kind of mutual fund companies or PMS firms that he has worked with? What has his performance there been like? What is the theme of the portfolio that they have launched? Is there a lot of buzz going around? Do you think the long-term trends of the market are aligned with the investment theme of the portfolio? What is the cost associated with investing? All of these factors are to be considered. Obviously, there are no returns or risk-adjusted returns that you're going to look at, but the other factors like whether it sits within your risk profile, whether the investment theme makes sense to you, whether the cost makes sense to you, all of these factors have to be considered. So in the fourth step, factor, there was understanding risk profile, there is investment theme, then there is volatility, and then there is cost. Except for this volatility angle, there are three other factors that you can still consider before investing into a new portfolio, and you should certainly do that. Now, finally, last but not the least, what happens when the portfolio is underperforming, right? Try to analyze the cost of what might be the underperformance. If you had invested in any small case March 2023, you would have seen like a long period of underperformance. So what is the reason? Is it because the portfolio manager is doing very, very badly, or is the market going through a funk? If the market is going through a funk, the portfolio manager can do no magic, and he does not have a magic wand that he can wave and generate returns for you. This is one other thing that I would like to clarify, because between Jan 2022 and March 2023, we got a lot of hate mail, people saying that, Arey, what is happening with my portfolio? You're not doing a good job. The portfolio is stuck at the same level for X number of months and all of these things. Yes, sir, the market was not doing well. There's nothing that we can do about it, right? So no portfolio manager can generate magic for you and sort of generate returns for you. If you're investing in equity, you should sort of be open to such long periods of underperformance. So now coming back to the underperformance, try to analyze what is happening. Is it a market fluctuation, or is there a more fundamental issue associated with the strategy of the manager or not? So these are the factors. Second thing, consider your time horizon, right? Investment in equity especially is it's a marathon. You have to sort of pace yourself. You have to be there for the long run. It's not a 100-meter sprint that you pick up pace, you make some returns, and you get out of the market, right? If you are an equity investor, right, not a trader, then it is a marathon. Go in with at least 5 to 7 years time frame, minimum 5 to 7 years time frame. Anything less than that, and you are putting yourself in risk. So consider your time horizon. If your goals are long term and stuff like that, if you are saving, if I am going to be saving for my daughter's education, which is probably 15-18 years away, my time frame is like very, very long term. I'm okay with any short term dips. I'm not going to be too concerned about it. But if your time frame is just a couple of years down the line, when you are going to retire and you need that chunk to sort of generate passive income for you, then you should be a little more worried, right? So consider all of these things if the portfolio is underperforming. And if especially in equity portfolios, 1 year of underperformance and stuff like that, check to see what is happening with the market. If the market is also underperforming and your portfolio is underperforming, most likely it is not the portfolio manager's fault, right? But if the market is doing well, your portfolio is underperforming, then try to check what is happening with the investment team. Did I miss out something on the investment team part? Is the manager taking bets which are very, very contrary? And he or she might be taking a contrarian bet, but is it going to does he or she expect it to work in the long term? Do I have the time to wait for that long term? All of these aspects have to be considered. Okay, so that sort of brings us to the end of the presentation. I'll just quickly take a couple of questions. Let's see if there are some interesting questions, and then we can sort of close it down. So Anubhav Saxena is the first one he's talking about. I expect following guidance from you time to time: when to add bulk, when to keep SIP, stop or go slow on SIP. If someone wants to get some money out, guide when to pull out money. So see, when to add bulk, when to keep SIP. If the markets are overvalued, then certainly don't add bulk, right? I think this is something that we've covered in the previous AMA also, where I specifically told you that markets are slightly in the overvalued territory, especially when it comes to mid and small cap companies. So don't go in for any bulk investments. The video, I'm sure, is still available on on small case platform, on small case YouTube channel. You can go back to look at it. When to keep SIP? Always keep SIP. Why? Unless and until you need money from that particular portfolio, there is no reason to stop your SIP, right? Stop or go slow on SIP. Unless and until you need money, why do you want to stop or go slow on SIP? I understand the underlying here is that people think there is some way to time the market, and I have told this again and again and again and again. There is no way to time the market. The simple way to time the market is go via SIP. It will result in rupee cost averaging. You don't have to worry about whether the market is up or down today. The money gets deducted from your account. Concentrate on other more important things in your life, right? And if someone wants to get some money out, guide when to pull out money. If you want money for some of your needs, then there is no guidance to it, right? Check to see which one of your portfolios have run up a lot. Probably pull out money from that particular portfolio. That is what I would say, Anubhav. It's pretty straightforward, right? Vipin Verma is talking about what should midterm investor 3 to 4 years should pick, moderate or high risk small case in current scenario. Vipin, like I just told you, there is a 4-step framework. First, what is your risk profile, right? Only you can answer this question. Second, based on your risk profile, what is the investment theme that you're comfortable with, or which investment theme will be a good fit for you? If your investment profile is aggressive and you have the time frame for it, then probably you can go in for thematic small cases. If your investment profile is moderate or conservative, then if it is conservative, then probably small case is not the route for you. So keep all of these factors in mind. We've just discussed the 4-step framework. You can use that framework. You can use a discover option on small case to sort of understand which small case is good for you. Sudhindra Ballari is talking about how do we calculate risk? What is the unit of risk? At least as far as small cases are concerned, if you go onto small case website or on the app, if you go onto the landing page of the small case, there is a fact sheet associated with each small case. Just click on that and search for Sharpe ratio. Sharpe ratio basically indicates risk-adjusted returns. It tells you what is the return that the small case has generated for every unit of risk. And you can compare the risk-adjusted returns for a couple of different small cases, and that should sort of help you arrive at the final answer. Yatin, where to see the risk-adjusted return parameter? I've told you. Explain ideal Sharpe ratio for a portfolio. I don't think there's an ideal Sharpe ratio. The cutoff, the hurdle rate for a Sharpe ratio would be 1, which means the portfolio should have generated more returns per unit of, more returns per unit of risk, right? If it is less, it means that it is taking more risk and not generating returns at all for you. So it should have generated more than 1 unit of return for every unit of risk that it has taken. But at the end of the day, there is no ideal thing, right? Depending on the underlying of the portfolio, the risk-adjusted returns will also be different. Depending on the time frame, the risk-adjusted return will be different. So those factors are there. Cyborg Gaming is saying, does saturation happen in some sectors or some stocks? How do I know if I should pull out and invest somewhere else? I'm not too sure. What is saturation? You mean demand saturation? You mean the stock has been discovered kind of thing? Yes, it is possible that, probably, I can't recall, I don't want to give you names of specific stocks, but there was this one particular stock, I'll not give you the name, which was into household appliances, which was making a niche kind of household appliance. It was undervalued for a fairly long period of time. Then the stock got discovered, which means there a lot of broker attention went to it. when I say broker attention, they started paying attention to how much margin the company was making, what was the return on equity and stuff like that. And they discovered that, it had been undervalued, but there was a lot of quality attached to that particular small case. So everybody started talking to that, and within a short period of 2 to 3 years, the stock price sort of ran up and the PE ratio reached above 100, right? And since then, the company has been doing good. The company has been selling the same amount of household durables and stuff like that, units of household durables, but the growth has not been exceptional, which means the stock price has been stuck at the same level for a period of time. There's not been any correction because it's a quality stock, but yes, something like that could happen. So, these are some of the things that I told you, like high PE ratio and all of those things. Those are if it is stuck, if a stock is stuck at the same level for a long period of time, then probably it's a good, you could understand that there is a certain kind of saturation. Pasang Lakpa is saying how to book profit on small case, sir. There is, you can either completely exit the small case if you need the money, or you can partially exit the small case. A simple Google search of partial exiting small case will give you instructions on how to do that, and you can check it out. Harsh Tiwari is saying recommended investment in value and momentum, minimum and maximum. Like there is no maximum, there is no cap that we have placed on this is the amount of money that you should invest in value and momentum. Obviously, those things will be based on your risk-taking capability, the investment horizon, and all of these aspects. What is the minimum? I think value and momentum small case now is trading at around somewhere like 1 lakh, and the Windmill Capital's fees is at around 8,000. So I would say if you have to get your expense ratio down to about 1%, then probably over a period of time, scale up your investment to about 8 lakh rupees in value and momentum. The minimum investment amount is already there on the small case. So, Harsh, I hope that answers your question. Vishal Tripathi, ideal amount to invest in a small case is recommended to be such that small subscription cost. Is there an upper limit also? No, there is no upper limit. Like I told, upper limit is based on your risk-taking profile. Where to find sharper ratio, I've already told. Vishal Tripathi, for example, when has subscription cost of 8%, can we go up to 20 lakhs since returns are good? Vishal, yes, you could go up to 20 lakhs since returns are good. But once again, value and momentum gives you exposure to a lot of mid and small cap stocks. So, like I told you, go back to understanding your own risk profile, go back to understanding what is the time horizon, go, check to see whether your income sources are stable, how many people are dependent on you in your family, and all of these factors, and then take a call on, whether you want to go up to 20 lakh rupees. Sumit Poriwal is Railways team for good investment right now. Sorry, we are not in the business of recommending specific sectors or anything of the sort. Yatin, is there any plan to launch a new basket of fee-based small cases by Windmill? Keep looking up. We are working on multiple projects. There are some exciting new products that are going to be available to you, Yatin. Please keep looking at our social media posts and stuff like that, and you will see. Remembered anything for day traders? No, sir, nothing at all. Okay, I think I've answered all of the questions that are here. And I hope you found this session helpful. So please go ahead and sort of use this investment framework before jumping into making any investments. Like I told you, this framework can be used for any portfolio investment, whether it is small case, whether it is mutual funds, whether it is PMS and stuff like that. So please go ahead and use this framework. And the risk assessment tool can be found for free online. Money Control has it, Mire Asset has it, Nippon India has it. Just search for risk assessment tool, and you'll find a lot of them. Take one of them, and that should sort of help you out with your investments. Okay, that sort of brings us to the end of the session. Thanks everybody for joining in. Have a good weekend. Thanks. Bye.